Talk about all this and more. Kyle Bass, founder and chief investment officer at Hayman Capital Management. I don't even know where to start, Kyle, so I'm just going to throw it right out there. What do you make of the stock market action the last couple of days?
First of all, Brian, pleasure to be here with you. Look, I think it's important to think about kind of the real big picture for a second. The Fed's balance sheet went from sub 1 trillion in 2008 to 4.5 trillion by 2019. And then from 2020, when the COVID hit, it went from 4 trillion to 9 trillion in 2 years. We added 40% more money to the system in 2-year period. So we got about 40% inflation. In fact, the housing index, the government's own housing index, was up 50% during Biden's term. So now the Fed has actually reduced its balance sheet by 25%. It's gone from 9 trillion to 6.7. And the Fed continues to quantitatively tighten on a daily basis. So there's no real structural positives from a monetary creation perspective to support the stock market. And now the tariffs are scaring investors. So, I think the tariffs are thoughtful. I think they will work. I think you've already seen Vietnam ask for a 90-day reprieve to negotiate. You're going to see a lot of first class plane tickets from delegations from all around the world coming to meet with the president to try to hammer this out.
Okay, let's go back. Let's go a little more into that word work. Okay, because we're CNBC, and I understand that a lot of people don't own stocks, but we serve that community. If we're looking at the screen right now, Kyle, it's red everywhere, right? I mean, markets are not, I hate to use the term collapsing, but they're down 8%, 10% in 2 or 3 days, and many are in technical bear markets. How would you define working with regards to the tariffs?
Look, how many times have you heard people complain in desperation and talk about the size of our deficit being 2 trillion on government revenues of what, 4.5 trillion? We must cut our deficit, Brian. The whole world's told us that. Our own economists tell us that. And so when Trump moves to do a couple of things that will close that deficit, number one, if Doge and Elon Musk are successful in cutting government expenditures, cutting the fat, let's say they cut, I don't know what your number is. I would say 400 to 600 billion is doable on a number of 6.5 trillion. That will be cutting 10% of government spending. U.S. government spending is 23% of GDP. That is a recessionary impulse, but it's necessary. The tariff move is akin to a currency devaluation. It will raise somewhere between 300 billion and 600 billion in external revenue. There is a path that Trump and Secretary Bessent are talking about here, taking us to showing us how we cut $1 trillion out of that deficit, right? When I talk about working, we're going to cut our deficit by $1 trillion, and we're going to reset what the term fair means with reciprocal tariffs. And so, yes, that's going to be difficult in the near term. In the long term, it's going to give us a positive foundation for growth.
Okay, so let's play devil's advocate on that point, Kyle, because I don't fundamentally disagree with you. There are a lot of 28-year-old, 31, 35-year-old viewers that are watching or listening right now. They don't own any stocks. They're trying to buy a home. It's too expensive. Mortgage rates are too expensive. Hell, everything is too expensive. We've talked about bringing down inflation and bringing down the price of energy. Okay, all those things are going to happen. Interest rates are coming down. Mortgage rates are coming down. Energy costs coming down. So there's a lot of people out there that maybe quietly will say, well, I don't own stocks. I don't really care about the Dow. This isn't the worst thing. But here's the problem. If you crash the economy to do it, if people lose their jobs and thus can't afford to buy the home, then what? What is the risk? We seem like we're walking a tightrope, Kyle, where, hey, if we can pull this off, that's great. But what if we fall?
Yeah, I mean, the real risk here is 10% of the top 10% of U.S. households represent 50% of consumption. Consumption is 68% of GDP. So the high end of the U.S. is what's been spending to keep our economy growing, and that's what's been driving jobs. So will that slow down? Yes. Look, I expect just with pure math, I expect U.S. GDP in real terms will drop 1.5% to 2%. Is that the end of the world? No. Could that change the psyche of investors and their spending? Potentially. But that's why, look, the Fed will be late. For certain, they'll be late. You can even hear it in Powell's response to the president asking for a rate cut. Certainly the yield curve will steepen. The front end's got to come down because the next two GDP prints are going to be difficult. It's going to look stagflationary, but it's going to get a lot better after that. And again, this is a restructuring we must engage in, Brian. We couldn't keep going the way that we went. Housing prices were up 50%, 50. If you look at the government's own housing index between 2020, 2024. And yes, there was a different president in the White House then, but it was a cost of living crisis caused by Congress and the Fed. And now what we're trying to do is reset kind of the crazy price moves that we saw over the last 4 years. And it's difficult. It's going to hurt. But this is, look, it's akin to a controlled burn. You know, are we going to have the Palisades fire? Or are we going to have a controlled burn with thoughtful leadership? I believe this is a controlled burn. I also believe that, you know, what's the NASDAQ down year to date, like 16, 17, the S&P's down 13.5. Look, the president himself and the administration, there is a put somewhere. My guess is it's somewhere down another 5-6% from here. So when you're asking 31-year-olds, 28-year-olds when you buy, you start buying in the next couple of months.